Hello, everyone. Welcome to Money Map. So we want to, based on certain events that happened in the global markets yesterday, we need to review President Biden's $1.9 trillion stimulus package, COVID stimulus package. So, as some of us probably know, the U.S. have provided some palliatives, some relief finance for families, for individuals since the pandemic broke out. And so this the third one, and President Biden is proposing 1.9 trillion just to support families, to make them, you know, get out of the current slump. Some of them have not earned in a while due to lockdown and other restrictions put in place because of the pandemic. So what's the package? The package is would cost an estimated $1.9 trillion. Still in the Congress and being reviewed by lawmakers, and it has been proposed that individuals that earn up to $75,000 per annum we get $1,400 each. Married couples we get $2,800 for the couple. That is if they earn up to $150,000. If they earn above that, then they won't get the full package. And so also part of the package will be that the minimum wage will rise to $15 per hour, and for children, every child and and all adult dependents we also earn. They will also get $1,400 each. And so what's the market reaction to this? Now we are talking about paying out money that people did not really earn. So they didn't earn it, that it's just like a gift, so to speak, to spur up the economy. But a lot of people feel, and most market participants think that this will lead to inflation because you now have money that people did not work for, and most importantly, even the US does not have the money. They have to print it out of thin air and share it to people. So whenever you have more money in circulation than the actual goods and services produced in that economy, then it just simply means that there will be general increase in price. So investors are looking at this and thinking, no, that this is going to lead to inflation, rise in inflation. And so for those investors who have invested in treasury yields. So treasury yields is just like what we know as a treasury, like treasury bills in Nigeria, or federal, or the bonds. Before now, you can see this is the chart of the treasury yield. This is for a 10-year treasury yield. So from around February 2020, it was about 1.28%, and it has gone down ever since. You can see from April 2020, just beginning to rise gradually from September 2020. So what that means is that if interest rate is low, it remains unattractive to investors, especially when it's so they rather move to equities, and that's why one of the reasons you are seeing huge movements in the stock market. Prices are rising. But now, because of this development, investors are thinking that if inflation is going to rise, if it's going to rise above this treasury yield, then there's no point holding the treasury yield, because they expect this stimulus money to cause a rise in inflation. So what are they doing? They are dumping their treasury yields. When they are so because and for you to dump, you have to make it attractive to the buyer. So to make it attractive to the buyer, you have to offer, a good price. So in fixed income, or which fixed income, which you can, the general name for investment like bonds, like treasury bills, because it pays you a fixed amount over a predefined period, right? For those kind of investments, yields an increase an increase in yield, will reduce the value of the investment. So these investors are actually going to get less than they will have gotten for offering higher yield. So what they are doing now is that, to make it attractive to buyers, they are offering to sell it at high yields, which is actually a loss to them. And so as that is happening, those who wants to now consider this yield again, because the yield is now high and is now attractive to new entrants. So some investors are dumping their stocks to move into treasury yield. So that scenario played out in Nigeria. It's been playing out in Nigeria in the last 1 week or so, when the federal government just announced new bond offering of about 16% for 10 years thereabout, and suddenly people are selling off their stocks because I mean, investment in yield should supposed to be a safe investment. The government will always meet up their payment. Worst case, they have to print money to pay you. So it's theoretically considered to as a risk-free investment. So that's the scenario playing out. Inflation is expected, rise in inflation is expected. People are selling off their stocks to buy this higher yield because they feel those who are selling it are selling because they feel that they cannot be, investing in treasury yield that gives them interest rate that is lower than inflation rate. It doesn't make sense. So they are exiting at higher yield, and which makes it attractive to other people from the stock market. So there's always a connection from one market, from one participant to the other. So what is a loss to someone is probably a gain to another person. So let's look at now we can see the impact of the market yesterday. These are the major indexes, US 30 futures as top 30 stocks in the US. You can see it went down 0.25%. 500 US 500 futures, Dow Jones, S&P 500. So generally speaking, yesterday the market went down because people are reacting to this increase in yield. So they are selling off and the yield is rising and stock market is going down. So what's the meaning of all these things? The implication to stock investor is that if this trend continues, you are probably going to have to readjust your position, your stock investment, US stock investment or global stock investment, to reflect the new interest rate. You have to revalue it because investors will move away from these stocks, and some of them will consider the safety provided by higher yield treasury treasury notes, right? So now, when talking about safety, as they are exiting the stock market, which investments are they going to take up? So let's look at where are the safety havens. Anything gold. So gold went down last week, but this time around, with the development in the market, we expect the price of gold to start rising again as people run to safety. So no government can go and print new gold anywhere, right? Because gold is scarce, is precious, is it can be used as a currency, it can be exchanged. So anything gold means that you can buy the physical gold, the gold bars, and keep. You can buy gold ETFs. You can buy gold stocks. So there are some companies that mine gold. So if you buy them now, because of the value of gold that is expected to rise, so also their shares will rise. So Bitcoin is seen as gold in many quarters because it's also scarce, and it's even better than gold in some ways, in the sense that you can divide it into the very small portion, right? You can get fraction of a millions of a Bitcoin. So it's attractive to a lot of people, and they trust in Bitcoin to preserve their value. So you expect with this event, we were looking at Bitcoin at $50,000, and so with this event, with this development, expect more upshoots in Bitcoin. And so also, and whenever Bitcoin is going up, you also see that other coins that we call alternate coins, they also rise together at the same time. So that's what's playing out for today. We keep on watching the market, and of course come back to you as usual. If you so please like the video, comment, subscribe to the channel, hit the notification button. Thank you very much.